Hey everybody, JC Peretz here, founder of AllStarCharts.com, and I am joined, as always, by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
What's happening, JC? You know, the people are waiting. I promoted this thing 1 o'clock or 3 o'clock Eastern. People are waiting.
I
Let's get to
know.
it.
Yeah. But let's remember now our discussion earlier about how bougie you are with your charts. You're like, oh, JC, we got this Caterpillar chart, but I think we could use a better one.
You hear that, Izzy? It's my fault. It's my fault now.
Listen, good things take time. You've been at All Star Charts and hanging out with us for a long time in a lot of different cities. And I think you're getting a little bougie with your charts. I do.
I do like a good chart. I do like a good
Listen,
chart.
I love that you're getting bougie about your charts. It makes me so happy that you like a good chart. So why don't before we get into the trade and the discussion, because I think there's a good lesson here, in addition to a nice idea, in my opinion, is the fact that we're talking about industrials and whether we're going to get the rotation into industrials. That would be the next logical step. If this were a bull market in equities and you're going to get an expansion in stocks that are making new highs, you're going to need some participation out of industrials. Maybe interest rates stop collapsing, start to, creep up a little bit. You get some rotation into things like financials, industrials, perhaps energy and metals and things of that nature. The S&P 500 is just in a sideways range, right? It's just kind of been churning sideways because while technology and growth have exploded, some of the more value-oriented areas of the market have sort of come down some after they were the initial leaders off the bottom in the back half of last year. So that's what this looks like right here. And here's a closer look, right? Kind of the S&P in this sideways range over the last year. Most people think it's going to end up like this, right? Fail. And you're going to break down and we're going to 3,400 on the S&P. And that's somebody who wants to put it nicely, right? We tend to get much lower price targets than that. But, what if it's like this, right? What if it's like this? The more times the level is tested, the higher the likelihood that it breaks. In my experience, right? It's only polite for it to knock on the door a few times before it goes barging in. And I think that that's what we're seeing here potentially. Everybody else seems to see here, Shawnee baby, keep seeing this top in industrials. The top, these are massive unwinds, right? And the way I learned it is that topping patterns and reversal patterns need something to reverse, something that needs to top out. And I just don't see that here. Like, you know what I'm saying? Like this, there's a lot more evidence that this is a digestion off the initial thrust off the lows than it is a massive topping pattern that's going to end some massive uptrend that clearly is not what's happening here. So what if it's not like that? Because if it is like that, Caterpillar is probably going to break down too. We're probably going to go down to last year's lows, right? That's the the logical progression there. If that is in fact a massive top in industrials that we're going to go down, Caterpillar is going to be your primary suspect. But if it's not,
I could hear the Head and Shoulders crowd chirping right now, looking at that chart you got up there. Like, that's a classic Head and Shoulders. Well, okay, maybe we'll find out.
Head and
But
shoulders are so rare because they're reversal patterns and asset prices trend. So if you're constantly looking for head and shoulders tops, you're going to get your face ripped off a lot. I know that because I've gotten my face ripped off, which is why we're putting this trade on.
So look, let's be clear with people here. This was not when you and I and the team were discussing this trade this morning. This was not a universal yes, let's go. In fact, I was giving you pushback on this trade because you at first presented it as, "Hey, this is a great risk reversal candidate. Let's sell some puts. What strike can we sell?" And I was like, no, let's tap the brakes here. I feel like, I don't like the look of this chart personally. I think there's a vacuum between 210 down to 220 that I don't want to get caught in if I was holding short puts. But, at the same time, you also convinced me that, like, look, if this bottom or this level here does hold, then the potential rewards here can be quite meaningful. Because we would basically be catching the low before the resumption higher. So, we kicked it back and forth. You were still pushing for risk reversal. I was arguing with you professionally, of course. But what I arrived at, what made me feel comfortable putting this trade on is I just wanted to keep it simple. I just want to buy calls because at least if this level gives out, there could be a whoosh lower. And if I'm holding long calls, or at least my risks are very clearly defined, I can size my position in a way that in the off chance that I would lose 100% of my capital on the trade, it wouldn't be a big deal. And so that made me feel a lot more comfortable with the trade. And that's what we ended up doing. We bought the November 240 strike calls. Now, the first question I always get from people is, why the 240? Why not the 210s or the 215s? The reason why I chose the 240 strike is because in November, which is the expiration we chose, those calls had a roughly 27, 28 delta, which means, at least right now, for every dollar that Caterpillar goes up, the options should increase approximately $27, $28, for every dollar move that Caterpillar moves. That's now, if Caterpillar keeps going, those calls will increase their delta, therefore they'll increase their gains as we go. But the nice thing about 25-ish delta options, and we've talked about this in the past, but it's been a while since we've talked about it. I like 25 delta options when I'm just buying the calls, because for me, it's a good balance between leverage when we get the trade right and affordability and low cost for when we get it wrong and we got to liquidate the trade. So that's why I chose a 240 strike. There's no magic in it other than I just like that it has approximately 25 delta, and that's why we're in there.
Hold on. So let's rewind a little bit and get back to why we decided to buy calls in the first place. I incorrectly assumed that we were going to get paid in selling those puts because of the decline that we've seen in Caterpillar. And I was incorrect in that presumption that we were going to get that. You were like, it's now worth it. We could just buy the calls. And I was like, all right, let's buy the calls. Remember, we were debating whether, to sell, I think it was the 180s, and I didn't think we needed to go that far out, or 175s. I think you wanted to sell. Like, we were going really far out. I was like, I think we could keep it tighter. And you're like, you know what, JC, we don't even need to sell the puts. Let's just buy the calls. And because volatility was low enough, a lot lower than I thought, we could just do that, right? So that's the thought process behind that.
You were totally right in thinking that volatility would be elevated, because we have seen this, not insignificant sell-off in Caterpillar since the beginning of the year. But lo and behold, the options market is, smarter than we think sometimes. And maybe they're watching this same key level that we're watching. And it's not until this level gets broken that maybe option players will start freaking out and start trying to hedge their positions, and then we'll see the volatility increase and the premiums increase. But right now, the options market's surprisingly complacent. So that's why I didn't want to sell the puts. I didn't think we were getting.
And then also another thing, I really like the risk reward, because for me, if it broke 200, all bets are off. So it doesn't matter. It's like risk reversal, fine. I'm happy to be naked short the puts, because if it breaks 200, we're out. Similar to that IWM trade we put on last week. So for me, I just really like the risk reward, because we're going to know if we're right very quickly, and we're going to know, more importantly, we're going to know if we're wrong very quickly. And that's what I like. I like knowing fast. I don't want to find out a month from now. I want to know now. Yeah. That was another reason I liked it, by the way.
Well, if you remember what I said to you in the meeting was that, yes, you're right. We're going to know pretty quickly if this thing is not going to hold support. But the problem, at least from my eyes, was I was concerned that if it loses support, we could be in for a 20-point flush really quickly. And that could be, if we're holding short puts, that could become a tricky position to manage. And I didn't want, that just made me uncomfortable. I don't like it.
I like it. So we're always going to err on the side of caution here, right? Notice how our main we're not talking about how much money we're going to make and what we're going to buy with that money. Like, we're very specifically focused on all the ways this can go wrong and what we're going to do about it, right? Like, that's our primary focus. So listen, Sean, appreciate it. Everybody, this has been another trade of the week with All-Star Options. My main man, Mr. Sean McLaughlin. Follow him on Twitter at OptionsSean. Follow me, JC, at All-Star Charts, and we will see you next week. Long Cat, November, 24 calls. Caterpillar, November, 240 calls. Caterpillar, November, 240 calls. Long, let's go. Get it.